Nobody knows anything. Not you, not me, not your favorite prognosticator prognosticating on your favorite financial prognostication program. Nobody has a clue. It doesn't matter how confident they might be. It doesn't matter how convicted they might sound. When it comes to market direction, randomness and unpredictability reign supreme. Okay, fair enough. But naturally then you might be asking, Jim, wait a second. Then how do I make any money in the market? I mean, even I know that investing 101 is pretty simple. I buy something. If it goes up, I make money. I short something. If it goes down, I make money. So if I don't know whether to buy or sell, because as you're telling me, nobody really knows, then what do I do? Here's what we do. We need to forget everything we thought we knew. We got to wipe the slate clean and start over. Rather than trying to trade direction, let's take a completely different approach. Let's take a totally novel angle at this whole thing, and let's start looking at volatility. And to do that, there are two specific volatility metrics that we are going to unpack in this video. We are going to look at IVR, or implied volatility rank, and then IV, or implied volatility. Now, as we do this, we are always going to take the position of the option seller. Now, if you are a beginner trader, man, my hat's off to you. I'm so glad that you are here. There is so much coming out for you from OUHQ, so just stay tuned. But this video, it might be a few steps further down the learning curve than where you might be right now, so just understand that. But we are going to take the position of the option seller. Now, if you are an option buyer, then understand that we are on the other side of the trade. Understand that we are on the other side of your position. We still love you. I mean, I still want you to be here. If for no other reason, then your boy needs that watch time. Okay, so first up, IVR, or implied volatility rank. What IVR measures is this. Where does implied volatility, so the raw implied volatility, where is that sitting relative to its previous 12-month range? So over the course of the previous 1 year, where is implied volatility relative to that range? The best way to think about this is the same way that you would think about an ACT or an SAT. Maybe you get your ACT scores back and you realize I'm in the 30th percentile of my English score. I was in the 30th percentile of my English score. So that meant when I took my ACT, my score was only higher than 30% of the other test takers that took that same section. Not too amazing. But at the same time, maybe you take an English score, maybe you take a math score, whatever, the math section. If your rank is in the 70th or 80th percentile, now you are higher than 70% of the other people that took that same section, or 80% of the other people that took that same section. Implied volatility rank is exactly the same. If I look at a stock with an IV rank of 20, that tells me that its current volatility levels, like where volatility is right now, it's only higher than 20% of the previous year's volatility. So not necessarily on the higher end of the range. On the other hand, if I look at IVR and it's at 75, now I know that current implied volatility is higher than 75% of the previous year's volatility. So now we could say it is on the higher end of that spectrum. And so when I'm inside of Tasty Trade, and I'm looking at like IWM right here, the IV rank is right next to it in the ticker box. So IWM has an IV rank of 20.3. I know based on our previous discussion, this is not necessarily high. It's also not single digits. It's also not beans in the teens. Like, it's not too bad. So if I go to IWM, it's 20. If I go to Meta, let's say, now it's 34.5. So now it's starting to climb the ranks a little bit. If I go to gold, let's say if I go to GLD, the gold index, now it's 36.5. So you can see the IV rank is right there next to the ticker symbol inside of Tasty Trade. And then another thing you can do is you can just click on this watch list, and this will bring up the different watch lists that are already pre-populated inside of Tasty Trade. So Tom's watch list is a good one to use. Another really good one to use, in my opinion, is the Tasty Default watch list. This is also fine because when you're inside of this watch list, it's really nice because you can sort by IVR. So if I just click on IVR, that's going to sort the list. Now it's sorted from low to high. I click it again. Now it's sorted from high to low. And so now I can look for high implied volatility opportunities based on IV rank to, again, take the position of the option seller. Okay, so why does all this matter? Well, I mean, when I'm trading, when I'm doing what I'm trying to do, I want to give myself the best possible chance to succeed. And you may want to do the same thing on your end. And so one of the ways that we can do that as an option seller is to sell when volatility is relatively high. And so again, looking at an IV rank that is maybe 30 or higher is a decent opportunity to potentially sell volatility in that underlying stock based on all the tasty research over the years. And so when I think about opportunities for new short premium or option selling positions, an IVR of 30 or higher is a really good starting point because volatility has a tendency to mean revert over time. So when it's high, it has a lot of pressure placed on it to move back down lower. When it's low, it has some pressure placed on it to move back up higher. Now, the reasons for that are beyond the scope of this video, so we're going to have to get to those in another video because, again, your boy needs that average view duration. But in addition to IVR, there's another volatility metric that ironically oftentimes gets forgotten, and it's even simpler and potentially even more important in some ways than IVR. It's the IV itself, the actual implied volatility, because when you look at an option pricing model, like a Black-Scholes model, let's say, the IV is what gets input into that model. It's what gets inserted into that model to then crank out the options price. IVR doesn't go into that model. IVR is a standalone metric that's just kind of giving us some feel or some sense of where implied volatility might be relative to itself. But when it comes to actually looking at the impact or the effect on the option price, it's always going to be driven by IV when it comes to volatility's impact on the options price. And here's the key thing to remember. High implied volatility leads to higher option prices. Lower implied volatility leads to lower option prices, ceteris paribus. And so they are going to follow each other forward through the forest. So if I'm going to be a volatility trader, if I'm going to be a volatility seller, even if I was going to be a volatility buyer, I probably want to be aware of this, right? I probably want to be aware of, where is the actual raw implied volatility on whatever stock or underlying asset that I'm interested in trading. And so when I'm inside of Tasty Trade, again, just looking at GLD, I can just look at this overview section right over here to the right, and this tells me what the IV index is. So the IV index, this is essentially the raw implied volatility of GLD. Now, you can never give just one number for implied volatility for a given stock, so IV index is the best that we have. And the reason why is because if I go to the trade page for GLD, first of all, you can see that if I look at all the expiration cycles that are upcoming, each one of them has its own independent, individual implied volatility. So again, it's a little bit of a misnomer to say, the IV on gold is 27.1 because it's like, well, what cycle are you looking at? What expiration date are you looking at? And then if you go inside of like the September cycle, you're going to see that each strike itself, if I change theta here to like implied volatility, where is implied volatility? There it is. You can see each strike has its own implied volatility. So it's almost like each expiration cycle, each strike, it's kind of like its own self-sustaining city in a lot of ways. It has its own set of metrics, its own set of pricing, and its own implied volatility. And to really drive this point home of why IV, or IV index in this case, to be very specific, is so valuable, if I go back to my Tasty Default watch list, and I sorted my watch list by stock price. So right now, we're going from low to high in stock price. So look at these two stocks right here. Look at Netflix and look at TLT. Right? They both have about an $80 per share price. But if we click on these and we look over in this overview box, you're going to see that the IV indexes are drastically different. So if I look at Netflix, I see the IV index is 34. Right? My IV index right there is 34. That's not too shabby. If I go to TLT, now look at this IV index, 12.2. We can basically round that down to 0 for our mental records. I mean, this is a very, very different type of trading experience, Netflix versus TLT. And you see this actually manifest itself right here on the option chain. So if I go to the trade page for Netflix, let's say, I open up September, just picking an expiration at random. It doesn't really matter. And I go to sell the at-the-money strike. Look at what I can collect for the at-the-money put in Netflix right now. $2.64. Okay, great. Let's do the same thing for TLT. So I go into TLT. I go to September. I go to sell the at the money strike, which again, I mean, the price is a little bit different, but now I'm only collecting 90 cents. So hopefully you can clearly see these are very, very different products, even though their prices are the same. Now, of course, one is Netflix, one is bonds. I mean, there's clearly a difference in that regard. But just from a volatility standpoint alone, this is something that can be really helpful to understand on the front end. So as you stop trading direction and as you start trading volatility, use these guys together. They're intended to go together. IVR and IV. They're just like buys and tries. They're just like post-workout and carbs. They're just like Splenda and basically anything. But when the dust settles and you have to make a choice, which one should you choose? For my money, I'm going to say IVR. Now, I know IV gets fed directly into the option pricing model. I know that IV is the thing that's directly impacting option prices. But I think IVR gives you a much better indication of the actual opportunity that may or may not be present in that underlying stock. But I want to know from you. Tell me down in the comments. Are you trading direction or are you trading volatility? Tell me down in the comments. What do you look at? IVR or IV? Get down there and let me know, if for no other reason than to simply pump that algo. We got to juice those robots. And of course, don't forget, you can sign up for the Trading Lab. It's completely free. Down in the description, man, you'll get ideas, you'll get inspiration, you will get B- dad jokes expressly delivered straight to your spam folder. And I'll see you guys next time.